If you've been following the commercial real estate industry over the last few years, you've probably noticed that most buyers have been almost entirely out of the market and sitting on the sidelines. But based on what we started to see at the tail end of last year and some things that we're likely to see in the very near future, there are a lot of signs pointing to transaction activity finally starting to pick up. And in this video, I want to walk through 3 reasons why that might be the case throughout the rest of 2025 and some major opportunities for investors that might come up as a result of this. So the first thing I want to highlight here is something that tends to affect the largest investment firms in the industry most, and this is that many funds are starting to deal with end-of-life issues where they may have to sell assets regardless of market conditions. A closed-end real estate fund that raises capital to buy or develop assets over a predetermined time frame will usually have an investment period of anywhere from between about 5 and 10 years, and at the end of that window of time, its assets will need to be liquidated. And this means that even if values in the market haven't fully recovered by the time that fund life is up, the properties in that portfolio will still usually need to be sold to return capital to investors based on the initial terms in the agreement. Now, in some cases, general partners in a real estate fund will have the ability to ask for an extension of this period, usually adding anywhere from about 1 to 2 years, but these will still typically need majority approval from the limited partners in the fund and sometimes even require reduced management fees to the GP throughout the extension period. And all of this ultimately means that there are billions of dollars in assets in real estate funds right now with managers that have been waiting for values to get back to where they were in early 2022 and with values still almost 18% off their peak, and the consensus expectation being that interest rates are going to stay higher for longer. There's a very good chance that a lot of fund investors will stop kicking the can down the road and start to liquidate assets. Now, the second big factor that I see that's very likely to drive more transaction volume this year comes from the buyer side of the equation, and this is related to the amount of capital that has been raised to buy distressed assets. According to JLL research and Preqin data, dry powder or equity capital allocated for investment in commercial real estate sat at almost $400 billion as of August of 2024. But if we zoom in on exactly what that capital was raised for, a significant portion of this was allocated towards what Preqin defines as opportunity funds, or funds that invest in high-risk real estate that provides high returns, with over $70 billion raised in opportunity funds in 2022 and over $55 billion raised in opportunity funds in 2023. But even though these fundraising numbers might sound impressive, a lot of these funds are structured with what's referred to as deployment windows of only about 2 to 3 years in total, meaning that these funds have to deploy this capital and buy assets during this time. And if they don't, in a lot of cases, they'll actually have to give that capital back at the end of the deployment window. And since fees and promoted interest that are generated by that committed capital through acquiring properties, managing a portfolio, and selling assets at a profit are huge revenue drivers for commercial real estate firms, giving this capital back and going out to try and raise capital again in today's market environment would essentially be a worst case scenario for many investment managers. And even for companies that aren't necessarily focused on maximizing profits right now while the market continues to stabilize, in a lot of cases, these fees related to assets under management are used to pay directly for company overhead, specifically employees' salaries and bonuses. And without this, companies that don't deploy capital and generate these fees may end up losing their most talented team members. All of these things together make it very likely that there's going to be a lot of pressure on the buy side this year to transact, with investors potentially even being willing to pay more to get deals done in 2025 for these reasons. And this is at the same time that sellers may be forced to accept lower valuations as their fund life and extensions ultimately come to a close. Now, the last thing I want to mention in this video, which could cause a major uptick in transaction volume throughout the rest of this year, is directly related to the record high construction activity we've seen over the last few years. And this is that many development projects that broke ground in 2021 and 2022 might not be able to refinance in the current interest rate environment. According to CBRE's Q4 2024 U.S. multifamily figures report, over 450,000 multifamily units were delivered in 2024, which was a record high nationally and over 8% higher than the 2023 figure. And in some specific US cities, these supply numbers get even more alarming, with markets like Austin, Texas, Orlando, Florida, Raleigh, North Carolina, and Nashville, Tennessee all seeing completions totaling over 5% of their existing multifamily inventory by the end of the year. And because of this influx of new supply, these markets averaged a year-over-year rent decrease of almost 3.6%. And if you think back to the kind of rent growth we saw back in 2021 and 2022, when developers were initially underwriting these projects, these rents today are falling well short of most developer projections. And when you combine this with inflation numbers that cause the cost of things like payroll, repairs and maintenance, and insurance to shoot up substantially during this time, a lot of developers aren't hitting their pro forma numbers right now, which is creating downward pressure on values at a time when property valuations are extremely important. Many of these projects were financed with construction loans that were only 2 to 3 years in length, with the expectation that these properties would be stabilized and refinanced at the end of that term, but with rents falling and interest rates having risen significantly over the last 3 years, the debt markets in commercial real estate today are making this pretty tough. All of this is leading to developers today finding themselves in situations where either refinance proceeds aren't enough to pay off their existing construction loan, or debt service costs are making a property really difficult to hold on to, and both of these things are leading developers to sell properties in 2025, in some cases even at a loss. Some investment firms are actually targeting newly built multifamily product for this reason specifically, with a goal to buy assets at a discount to replacement cost, ideally from a distressed seller, and the plan to take advantage of an increase in rents over time as new deliveries ultimately taper off. So if you're wondering when commercial real estate transaction activity will finally start to pick up, this is my best guess as to when and why that will happen. And if you're looking to break into this industry in 2025 and you want to make sure you have the technical skills you'll need to make it through the interview process at top commercial real estate investment and development firms, make sure to check out our all-in-one membership training platform, Break Into CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break Into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on commercial real estate market trends, make sure to hit the like button and let me know in the comments where you think transaction activity is headed throughout the rest of the year. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.